welcome. You're listening to the Best of Investing on Talk 910, the show where we present valuable information about real estate, the financial markets, and other economic business of the day. And for those of you listening for the first time, here's our format. A few guys sitting around a bar having drinks without the drinks, talking business with you, the audience listening in. I'm your host, Edward Brown, and I'm pleased to have as my co-host Mark Hanf of Pacific Private Money, California's fastest growing private lender. Our phone number is 888-912-1190. Write that number down, 888-912-1190, because you're going to use that number to answer the trivia questions for 3 vacations given away during each commercial break. That's right, we're giving away 9 vacations during this show. Now, the vacations are not sponsored by the radio station, but by Lighthouse Resort and Marina, located 1 hour northeast of San Francisco, and the vacations are free. Their only request, a $75 cleaning fee to cover housekeeping expenses, such a deal. Their website is lighthouse4fun.com. Check them out. You can reach them at 916-777-5511. Today's trivia theme is one-word title movies of the 1980s. Our website is bestofinvesting.com. Check us out on Facebook and YouTube by typing Best of Investing Radio Show. We're also on television, Comcast, Channel 26 and AT&T, Channel 99 on Saturdays at noon and Sundays at 6 p.m. Now, today's special guest is William Hazelgrove, who's going to discuss lessons we can learn about the economic downturn from the Great Gatsby. William, welcome to the Best of Investing.
Oh, thank you.
Okay. Go ahead, Mark.
So tell us about your book, William.
I wrote a book called Rocket Man, which actually is a novel that basically describes what happened to the country when the economic downturn hit. And coincidentally, the Great Gatsby came out, and everybody's familiar with that story, the rags to riches. And one of the things that I noticed in writing the book was the parallels between that time and ours. The only reason we didn't slip into a Great Depression was because of the government coming in and infusing all that cash. But the difference is probably more one of timing, because we had an immense amount of people who lost money in real estate, just like the stock market during the Great Gatsby's time, and everybody was in it. The parallel is during the 20s, everybody was in the stock market. Well, when the crash hit the United States in 2008, you were all in real estate.
Okay, and that's what I was going to ask you is one of the things that you had sent in your information to me is why you should not own a home. So this will be kind of interesting. I want to hear this.
You think about it. We all started out, the American dream was wrapped up with own a home. This is the big investment of your life, and you should own it. And the whole middle class was really based on having this home that would appreciate to a point where you could sell it, make your nest egg, and retire. Well, that inverted to the point where that home became a liability and actually started pulling everybody down, because we now have half of the mortgages are upside down. So when you think of investment, you think, well, where do you really want to put your money? Well, you really shouldn't put it in this thing where you're paying taxes. It's not a good investment. It's going to suck up a sizable part of your income. You're better off in the market, just because it's not what it was. Now, if you're going to live there, for 25 years, fine. But most people don't do that. Most people move around. They stay in a house for a while, then they move.
About 5 years is average.
So, I guess my argument would be one of, renting, and I'm nothing new here. This is all over the media. Renting looks a lot better, just because, you're fluid, you can move around, you aren't, sunk into this big investment, which was the biggest investment of the middle class.
So even with the tax breaks of paying the mortgage and the real estate taxes, you're still advocating renting versus buying?
Well, I mean, if you can take that mortgage deduction, fantastic. Again, what do we hear? What is the thing that a lot of people talk about? They talk about doing away with that mortgage deduction for taxes. Again, if that's your home, fantastic. But if you're looking at it in terms of, in Chicago, we have a lot of mortgages that are upside down here, and we have very high taxes. So you're paying tax on a house that was worth maybe $500,000 in the boom, and now is worth $300,000. Yet the taxes have not gone down.
Yeah. Well, how much are the real estate taxes? Like here in California, it's about 1.125% plus than all these assessments. What is it in Chicago?
It's about 1.8%.
Whoa, it's like Oakland. Yeah. Oakland's like that.
Well, that's interesting, William, because it's nice to get a perspective from another part of the country. Because what's interesting here and what's the dynamic in California is you got a situation where in many neighborhoods, particularly in the San Francisco Bay Area, rents are actually rentals are actually difficult to find, and those that you can find are the rents have been going up and up and up in California. So from that standpoint, I think a lot of people here in the Bay Area would prefer to own a home rather than rent. But then you're also facing the fact that real estate prices in many markets have returned to their boom levels, and we've got scarce inventory. So it's really we're heading into 2014 now, and the market's really in a flux. But I find it interesting that apparently in Chicago, or maybe in the statewide in Illinois, you're talking about situations where it looks like people have not been able to benefit from declining prices in terms of seeing their real estate taxes go down.
Oh, absolutely. And, the economy is very siloed now, right? California, I've been reading about your appreciation there for a long time. You guys have come back. Chicagoland has not. In fact, we just had a huge flood of foreclosures that are still all over the market. I live in a suburb of Chicago, and I can just drive around and see empty houses, huge empty houses that middle-class people lost. So in the Midwest, we still have an immense amount, a glut of foreclosures, we have high taxes, and we have inverted mortgages. A lot of people cannot get into the mortgage market again because even with HARP, right, which will give us 150% or something with participating banks, a lot of people can't take advantage of that. It's still beyond. That's why Obama's talking about HARP 3, because beyond the Fannie and Freddie loans, let's face it, nobody can get their loans refinanced now.
Well, let me ask you, because you've also written down on here that it's okay to walk away from a home you can no longer afford.
Well, let's think about that. Somebody who's rich and buys a home as an investment, the minute that home goes south, they're like, okay, I'm done. And they just let it go. Middle-class people have a lot more middle-class morality, if you will.
Yeah.
But let's say you're paying, this is just an average payment here in Chicago, $2,600, maybe $3,000 a month plus your taxes. Yet your home, let's say you bought it at $400, is now worth $200,000. You will not get that equity back. It's not going to come back. So now you're paying on this asset that is way inverted, right? Your taxes are still high, and you're paying $3,000 a month.
Well, let me ask you, in Chicago, do they lower the real estate taxes based on the new value?
No, absolutely not. No.
That's insane.
No.
That is ridiculous.
No. I mean, you get I petitioned my own taxes several times to get maybe a, $300 bump off it or something, but it's nothing.
Wow, no, that's good. That is different here in California. So let me ask you then, how the middle class Americans got the shaft while the wealthy remained unscathed by the economic collapse. How did that happen?
Well, I mean, let's face it. The middle class is the ones who all bought in, hook, line, and sinker into the thing of I'm going to take a mortgage, and also I'm going to, leverage myself up as high as I can into these homes. Let's take a guy who took a 3% interest-only mortgage and leveraged himself into, say, a $600,000 home. Maybe on the income of a butcher, and I know people who did this. Right in Chicago, people just went crazy. Well, so when it fell, just like a margin call, you had all this leveraged debt, and suddenly a lot of the interest only notes expired, and so we have to make full payments. And that, of course, started the subprime collapse.
Yeah, but then how did the wealthy remain unscathed?
Well, and the wealthy, wealthy use cash, correct? They have the tax breaks, the tax shelters to keep themselves above the fray, if you will. And they still have mobility. I think the biggest thing that's happened to the middle class is that they're stuck. I mean, people literally, I don't know what's like in California, but here, people can't move. Because if you move, you'll take a bath. And in my book, Rocket Man, I describe a guy who's in a house, with his family, he did just that. He came in during the top of the bubble, bought, it collapsed, and he stuck. Because the second he moved, say that $300,000 he put down the house, that's gone. And it may be gone anyway.
Yeah.
The second you have the short sale, and they call it here, I don't know what they call it in California, they call it strategic default here.
Yeah,
People
that's right.
just walk away from the house.
Yeah, because it's non-recourse debt on that.
Right.
So last question I wanted to ask you, and then I think Mark wants to ask one more, is what's the new American dream look like, and how do you attain it?
Well, I would say it's one of simplicity. What's the thing you hear from everybody now? Downsize. I want to downsize. I want to simplify my life. So what do we do? We're going back to something that was behind us. We all bought the whole mantra of bigger is better for years and years and years. Well, now people want something more simple. So you have this movement of going back to more like, the way a lot of people grew up, which was a smaller home, less debt, more in a community-based environment where people are actually interacting with people. So I think when you think of the American dream, we always think economically, but really it's a cultural dream. It's one of being middle class. It's one of stability, which we don't have now. Most people are still afraid they're going to lose their job or their house. So stability is a big factor, and having time to enjoy the fruits of the American dream. So I would say that's what I mean when it's behind us. It's something that we had before, but we lost in this big rush to bigger is better, more.
Okay, so William, we're gonna let Mark ask one more question, then we're gonna find out how to get a hold of your book, and then we're gonna let you go. Okay?
I'm reading here about, you've got two books here. You've got The Rocket Man, you've got the Pitcher. Would you say there's like a recurring theme in the books that you've written, William?
Yeah, in the picture we've got a Mexican-American kid who has no money at all, and I don't know if you're familiar with kid sports, but you need kid sports to compete, money, and so he gets this broken down World Series pitcher to help him make the high school team. Again, he's sort of improvising to try and get around the fact he doesn't have money. And in Rocket Man, it's about the upside down American dream. It's about what happens to the middle class, and this guy is struggling to keep his home and his family together during the big crash.
Great. Hey, William Hazelgrove, how do we get a hold of your book, or how do the listeners get a hold of your book?
You can get them at Barnes & Noble, but you go to WilliamHazelgrove.com or just put in Rocket Man novel or Pitcher. The Pitcher novel, which again is about a World Series pitcher who helps a Mexican-American kid get his dream. And then Rocket Man is really just about the upside-down American dream, sort of a catcher in the rye of the Great Recession.
Oh.
You can put any of those, Amazon, wherever, Rocket Man novel, the Pitcher novel, you can get it.
Sounds interesting. William Hazelgrove, thanks for being a guest today on The Best of Investing.
Thanks, William.
Okay, thank you.
All right, we are going to cut to our first commercial break here, and the theme is one-word title movies of the 1980s. Which action movie starred Sean Connery? Again, one-word title of the 1980s. The first three callers with the correct answer win a free 3-day, 2-night stay at the Lighthouse Resort, and this is not as easy. I thought this was easy, and I was wrong. Their website is lighthouseforfun.com. Call 888-912-1190. That's 888-912-1190 to answer this question. Which action movie starred Sean Connery? Again, we're talking about one-word title movies of the 1980s. 888-912-1190. Make sure to include your name and your email address. Speak slowly. Spell out your email one letter at a time. Don't touch that dial. The Best of Investing will be right back.
Indeed.
All right. So now it's not the robot here. It's just you and me.
Mm-hmm.
So you can, I guess, just get right into like, well, you know what?
I have a comment. We can just chat a little bit about the guest.
Okay. Yeah, Chicago's a little different than here. City. Welcome back to the Best of Investing. I'm Edward Brown, your host, along with Mark Hahn, president of Pacific Private Money. When we cut to the first commercial break, we asked this trivia question. Again, the theme is one-word title movies of the 1980s. Which action movie starred Sean Connery?
I can't guess it.
I was thinking it was one of the James Bond ones called Octopussy, but that wasn't it because that was Roger Moore. The movie is called Highlander.
Oh, that's.
And I never saw it.
Never guessed
I never guessed that. Okay. Mark, you wanted to make a comment about our guest.
Yeah, we had William Hazelgrove, an author from Chicago, who was talking to us last segment. He wrote a couple of books, The Pitcher and Rocket Man, and he was talking about the real estate market as it exists today in Chicago. And I got, quite frankly, I was surprised and shocked to hear that valuations are still so much
taxes.
depressed from what they were at the height of the market. Number one, because he was talking about, he used an example, although I know he just used an example of, you paid $400,000 and now their home's worth $200,000. But he was telling us that valuations have nowhere near recovered to the post-bubble, pre-bubble highs. But second also is that if you're a homeowner in Chicago area and your home is worth half what you paid for it, your real estate taxes are still what they were when you bought it. Because here in California, we're used to and we're accustomed to property taxes being equal to 1% of your property's value. And so what most of us did when the market corrected is we went to the county assessor and we submitted a form for new valuations and a new assessment. But apparently in Illinois, or maybe Chicago specifically,
they only go up.
They only go up. But I tell you also from a real estate investment standpoint, hearing that there's still a lot of distressed homes. And you mentioned driving through neighborhoods and seeing vacant homes all over the place. That's as much as I feel bad for the human component, the human drama component of it, but it just kind of almost gets me giddy to think, oh my gosh, you go to Chicago and there's still a lot of real estate investment opportunities in different parts of the country.
Sure.
And I know that there are people in California who promote real estate investment opportunities in other states.
Yeah.
I've always been a little bit skeptical of those, but here's a first-person, storyline from a guy who's saying, look, where I come from in Chicago, people have gotten hurt, people are still hurt, people are paying taxes based on inflated values, and he was talking about the fact that, in his opinion, he doesn't believe that home ownership is something worth striving for in his market. Now, I know that's certainly different than what
I can understand that where, if you, especially, you put $200,000, let's say you put $200,000 down and bought a $400,000 house, and then it goes down to, $210,000, and your $200,000 value is now eaten up. That's, you pretty much lost it all.
Yeah, so contrast that with with California, where many markets have returned to at or near the highs from 2007, and you've also got a real estate investment scenario where there's not nearly as many opportunities to find deals in real estate or on real estate as there were, say, 2 or 3 years ago. And then you've got markets in other parts of the country. Kind of gets me excited to maybe look into that, except for the fact that he told us it was 4 degrees.
Yeah, exactly.
4 degrees in Chicago, and here we are at 72 degrees in the middle of January in the Bay Area.
Well, that's why there's a lot of
suffering
houses,
in our drought here.
a lot of houses that are still empty, probably.
Yeah, that's just amazing. So, but anyway, that was interesting. That was nice to get a different perspective, because, like as we've talked about on this show many times over, we kind of specialize here in Bay Area real estate. We talk about the Bay Area real estate market or the California real estate market, on a fairly regular basis. And so, to hear what is happening and what opportunities there are in other parts of the country, if you can stomach the chill, then maybe Chicago is worth investigating.
Yeah, maybe. Yeah. Tell you what, Mark, I want to shift right on over to you because
well, thank you.
Tell us about a recent loan that you are about to fund with somebody who doesn't have much skin in the game, which is normally not your cup of tea that you like to lend on, but you're going to do the loan because of the equity partner. Well, explain to people what you
What
do.
Edward's talking about, well, first of all, let me just reintroduce myself. I'm Mark Hoff. I'm broker and president of Pacific Private Money. We are a private money lender to real estate investors, oftentimes called hard money, but I tend to prefer the new name that most of us are using in this new lending environment. We're not making seconds, and we're not making consumer home loans. We don't lend to people in distress, but we lend on distressed properties to real estate investors who, for the past 5 years, have been buying, fixing, and flipping distressed property and selling it at a profit. And we've been providing capital to those borrowers because after 2008, the banks largely stopped making those types of loans, number one. And even the ones that are still making those types of loans generally can't close fast enough. And in this market environment that we're in right now, speed is almost always of the essence. And so we're able to close oftentimes in less than a week, and on 70% loans that we make, loan to purchase price to real estate investors. And so what Edward's talking about, because we were talking about this off the air, is a loan that we're actually going to close next week. So again, we tend to make conservative loans at Pacific Private Money, and our loans are funded by capital from our individual client investors who get yields of 8% and more on their money by allowing us to use their funds to originate loans to real estate investors, short-term loans. So here's a loan scenario that came in last week, and again, we're going to close it next week. And the borrower is buying a home for $220,000 in the greater Sacramento area. I saw the appraisal on the property, and the home is, in pretty ugly shape. I mean, you look at the home, ugly paint, old kitchen, everything needs to be updated.
Would you consider it a fixer-upper?
It's a total fixer. It doesn't even look like you could really want to move in there. I mean, I don't even think I would even try to rent this property. It's just been, it's been painted and neglected. It's been neglected for some time. So he's buying it for $220,000. He's getting a good price on this. But here's what's interesting about this. So we're going to make him a 70% loan. We're going to loan him $150,000 on this $220,000 purchase. Now, typically, our borrowers have the cash for the down payment, the 30% down. In this case, it would be the $50,000 in cash to come down and close the loan. So, I'm sorry, I was right the first time. $70,000 down payment. Okay, let's do math in my head here. So, but what's interesting about this one is that he's using an equity partner who's providing him a loan in second position. And so why this is worth discussing is that, in the lending industry, oftentimes people will say, well, how much skin in the game do you have? In other words, how much cash are you putting into the deal? Well, here's a borrower that is actually putting up no money in this deal. He is a licensed general contractor and a real estate broker. That's one of the reasons why I like this scenario. And he has an investment partner who's coming in with all of the money for the down payment, all of the money for the estimated holding costs, which is the interest and taxes during the 6 months they predict it will take them to fix and flip, and the equity partner, the capital partners coming in with the remodeling funds too. So they're coming in with about $125,000 total behind our $150. So it's going to be a first and a second on this property. The first is $150, the second is $125,000, and the purchase price is $220,000.
I think it's important to point out that if anything goes wrong, you get paid first.
Absolutely, and it also, I happen to know the people who are making the second loan. They are also real estate investors. I say they because they're a team of real estate professionals that include contractors, brokers, and money partners who, as a business model, make secondary loans to contractors and rehabbers who are short on capital but have found a project that has profit potential. And so they're basically going to split the profits with this contractor on this deal. Now, this contractor, it's not that he has no net worth or that his balance sheet, that he has nothing. because he has money tied up in other real estate. But as oftentimes happens is, people have the capacity to do multiple projects simultaneously from a skills standpoint. He has a crew that he wants to keep busy, and he's going to put them to work on this project, but he's got his capital tied up on other projects, including one that's on the market right now. So here, he's taking advantage of the fact that he can find a capital partner who will provide the funds for his down payment and his remodeling costs for a negotiated split of the profits. And me as a primary lender, I like that because now I have someone whose loan is behind mine, and for all intents and purposes, he's a guarantor. He's going to make sure that if the contractor stumbles and walks away from the project for any reason, that secondary lender, that capital partner, will come in and finish the project on their own, sell it, and make sure we get paid off.
And again, what did you charge this borrower?
This note was 11% and 4 points. 11%
Wow.
and 4 points.
11% 4 points for a 1-year loan.
Yep.
And you split half the points with the fund, and the fund gets the whole 11%.
Right, we didn't get a
That's
chance
a
to talk about
smoking
that, but at Pacific Private Money, we have a mortgage pool fund that we use to originate these loans, and our investors are actually shareholders in this mortgage pool fund, and they get paid the majority of the earnings of the fund, which right now is paying on average 8.5%.
Okay, and when we come back from the next commercial break, we're going to let you tell people how they can invest in the fund, which is going to participate in that loan.
Absolutely.
Okay, again, the theme is one-word title movies of the 1980s. Here's the second trivia question. What movie series released the most sequels in the 1980s? The first 3 callers with the correct answer win a free 3-day 2-night stay at the Lighthouse Resort. Their website is lighthouse4fun.com. Call 888-912-1190. That's 888-912-1190 to answer this question. What movie series released the most sequels in the 1980s? Call 888-912-1190. Make sure to include your name and your email address. Speak slowly. Spell out your email one letter at a time. Don't touch that dial. When we come back, the best of investing, we'll have Mark Hunt explain how to invest in his fund that is currently yielding over 8%.
So I got a call from a listener. Actually, not a listener to the radio show. He went to, I think he went to the Best of Investing website because he was watching one of your podcast videos.
Oh.
And he's calling me to go, Mark, did you realize that it's still recording in between your sessions? That when you're off the air, that it's still recording and they can hear what you're saying. And as he's telling me this, I'm thinking,
What did I say?
oh my God, what did we say? Did we did we swear? Did we say something like untoward? He said, well, no, you were talking about what you were going to say in the next segment. What else are we going to talk about during the break? So anyway, he just wanted me or us to know that, oh, by the way, you're still being recorded, during the commercial break.
I used to split it off into 4 different segments, and it just got to be too much of a hassle.
Yeah.
So that's why I just remember that we're recording so that we don't swear or take off all our clothes or anything silly.
Yeah, exactly.
That's the only reason he called? That's funny.
I don't remember anymore. If I'm sure I sent him off with some goodies before I'm sure he did. Yeah.
Okay, here we go.
Okay.
Welcome back to the Best of Investing. I'm Edward Brown, your host, along with Mark Hunt, president of Pacific Private Money. When we cut to the second commercial break, we ask this trivia question. Again, the theme is one-word title movies of the 1980s. What movie series released the most sequels in the 1980s? Mark?
All I could think of is 2-word titles like Lethal Weapon or Star Wars or Die Hard.
And unfortunately, it was Halloween. And it was not,
yes.
I thought it was the Rocky movies because they had, Rocky 38,
Right.
Rocky wears Depends because he's getting so old. But no, a lot of the Rocky movies were in the at least 1 or 2 were in the 1970s.
Yes.
So the answer was Halloween. Okay, before we get into you explaining how people can invest specifically in your fund, Last week we had a special trivia contest where the winner won a 2-night stay at the beautiful Hyatt Palm Springs.
Oh.
So centered in the heart of downtown Palm Springs, the Hyatt Palm Springs sits at the crossroads of one of the most memorable vacation destinations in Southern California. The hotel offers stunning views of the San Jacinto Mountains and is footsteps away to hiking trails. The Hyatt Palm Springs features 197 spacious suites, VIP suites, and poolside cabana suites. The hotel offers more than 12,000 square feet of indoor-outdoor meeting space and is the only hotel with an outside cafe with entertainment in downtown Palm Springs. They also have a complimentary shuttle to and from the airport and throughout downtown, including the convention center. For more information, visit www.hyattpalmsprings.com or call the hotel directly, 760-322-9000. That is quite a beautiful hotel, I gotta say.
Absolutely.
So here was the trivia question. What is the third most popular thing that most people said they could not do without?
Their cell phone?
Okay, the first is the internet,
Okay.
second is TV, and third was cuddling. Now come here, Mark. I need a hug right now. Okay, it's not win, and our winner was Andrea. I guess that's how I pronounce it. Andrea in Cupertino.
Wow,
Just
good
must have
guess.
researched that one.
Well done.
Okay, so Mark, how do people invest in your fund? Because it's interesting. And then you know what? When we come back after the next break, we have a very interesting email that we received for you. So, how do people invest with you?
Well, at Pacific Private Money, we have an investment vehicle that we call the Pacific Private Money Fund. And think of it as a mutual fund of real estate secured notes. So we believe that it is one of the, if not the most conservative investment opportunity that provides safety and security features that you're not going to find in the stock market, yet the returns that we're providing year in and year out, in many cases, are much better and superior to the stock market because, again, we're not in a situation where loss of principal is a likelihood based on the type of loans we do.
Well, the last loan that you talked about that you're about to do, 11% and 4 points.
On a 70% loan to purchase price.
And
where
1 year
we have-
loan?
And a 1 year loan
That's
where we have
pretty high.
a secondary guarantor behind us. So the Pacific Private Money Fund is an opportunity for investors, but we actually call them shareholders because, technically speaking, you're not even really an investor because when you lend money secured by real estate, that's not an investment. That is a loan. That is a contract that you make with the owner of a property where where the money will be lent to him, secured by a contract on how repayment is going to be made and the penalties if it's not, and that's secured by a recorded deed of trust. And Pacific Private Money specializes in making short-term loans to real estate investors who are in the business of buying, fixing, and flipping real estate in Northern California. And we've been doing that now successfully for over 600 loans for the past 5 years. And so last year we started the program and we launched the Pacific Private Money Fund in response to the growing demand by listeners, many of the listeners to the Best of Investing who've been calling saying, you keep talking about all this money that you can make in private lending. How do I participate in that? Well, I grew my business from 2008 largely by using a small group of high net worth individuals who understood real estate very, very well, and they were my source of capital. They liked the loans that I was originating, and I've been using their capital, and they've been earning, returns between 8 and 10% on that money. Well, in response to the growing inquiries that I've received, we launched the Pacific Private Money Fund as a way for the average individual who really is unable to take advantage of private lending on a direct basis, meaning directly fund a loan to a private individual.
Well,
which some
or
people
also,
do.
maybe they don't want to drive around the Bay Area looking at each property.
Right, looking at properties, evaluating loans, calling and trying to get in on an individual loan, only to find that it's already been sold to somebody else. You're the fifth person who called that hour on that loan. It was sold days ago. I mean, there is a strong competition among loan originators for people who do not have a fund and are trying to fund, or not trying, but they are funding loans individually. So we launched the Pacific Private Money Fund, and to date we've got close to 30 investors that have invested, including some prominent local real estate attorney, some financial planners, of course you and me. And so
quite pleased with it.
that's right, and so we use that fund to originate our loans. And so the way the fund works is actually very, very simple. The shareholders earn a preferred return of 7% on their invested capital, and then there's a split of the profits 50-50 with the fund manager. Now, the best part about how the fund makes its money is that, first of all, the fund earns 100% of the note rate. So if we lend the money out at 10%, the fund gets all of that. We service the loan in exchange for our management fee. Secondarily, the profits are split, as I said, 50-50, but it not only earns 100% of the note rate, but we also split the origination points with the shareholders, and that's unique among funds. There are very, very few funds that I'm aware of where not only do the shareholders benefit from all of the note rate, not a note rate net of servicing costs, but actually all the note rate, and that the broker shares half of the origination.
And the reason for that is because you're not greedy.
Well, it's the
I've
nature.
seen a lot of those, and you're right. Usually the brokers don't share.
We designed the fund to be successful in the type of market we're lending in. What do I mean by that? Well, a lot of our loans are very, very short term. And so if you're a private individual investor out there and you've done private lending before, you know that you don't want to invest in a individual loan that's too short or too long. And in fact, a lot of the guys that I used to work with didn't want to do a loan unless it was going to be, unless the borrower would hold it for at least a year.
Is that what you call a Goldilocks loan? Not too short, not too long?
That's right. And so, but in today's market where people earn a profit by remodeling and flipping a house very quickly, I've done deals with people where, they were buying a product at the auction and then turning around and selling it, and maybe within 60 to 90 days turning the property over. And so if they were to use capital, they want a no prepayment penalty loan. So they're willing to pay the points, but they don't want to guarantee much in the way of interest payments.
Well, here's the other thing is, we talked about this earlier. We met with Gil Gross, who has a show on 910.
Yeah, absolutely.
And very nice guy. And he mentioned on his show specifically, he knows of somebody who is a stellar borrower, has got great credit, lots of cash, has a great job, but he couldn't get a loan from the bank. And the reason was because he changed from being a W-2 employee to being self-employed. And the bank said, well, you don't have 2 years history of being self-employed. So even though he's doing the same job, his tax return is going to show something different. They said, come back to us in 2 years.
Right, so he has to go to a private lender like Pacific in order to close on a real estate deal. And that's very typical of the type of loans we do. And so again, investing in the fund is very easy. And for more information, give us a call at Pacific Private Money. We're at 415-883-2150. That's 415-883-2150. And be sure to visit our website at pacificprivatemoney.com.
Great. And then when we cut, we're going to cut to our third and final commercial break. When we come back, we have two things that I want to cover. One is a very interesting email we got from a listener. And the other thing is, you're not going to believe what was going on between the Postal Service and Staples. All right? So here's the third and final trivia question. Again, the theme is one-word title movies of the 1980s. Steve Martin starred in this movie based on the classic tale of Cyrano de Bergerac. What was the name of the movie? The first three callers with the correct answer win a free 3-day, 2-night stay at the Lighthouse Resort. Their website is lighthouseforfun.com. Call 888-912-1190. That's 888-912-1190 to answer this question. Steve Martin starred in this movie based on the classic tale of Cyrano de Bergerac. What was the name of the movie? And in fact, the Police did a song with the same title. Make sure to include your name and your email address. Speak slowly. Spell out your email one letter at a time. Don't touch that dial. The Best of Investing will be right back.
This is the boring interlude between sets.
That's true, especially when I have to figure out how much time we have left.
That's right. When you got to do math.
That's right. The new math.
New math. I got a missed call from Southern California. I get calls from all over the country, and I always know if it's like from the East Coast, it's a hang up. It's always like a sales call.
Oh.
I don't know how they got my phone number.
Short segment here.
Okay.
Wow.
20 seconds?
4 minutes 50 to take out. 20 seconds. All right, just say goodbye.
Yeah.
All right, so let me cover this very quickly here.
Okay. Do you want to do yours first?
No, we'll do yours first.
Okay.
Here we go. Welcome back to the Best of Investing. I'm Edward Brown, your host, along with Mark Hahn. And when we cut to the third and final commercial break, we ask this trivia question. Again, the theme is one-word title movies of the 1980s. Steve Martin starred in this movie based on the classic tale of Cyrano de Bergerac. What was the name of the movie?
I didn't know until you mentioned the song by the Police, so that'd be Roxanne.
Roxanne. That's right. Very good. Okay, Mark, we received an email for you, kind of along the lines of what you had earlier been talking about. It says, I like the idea of investing in a diversified pool of portfolio of mortgages, but I want the flexibility of liquidity. Can you address that?
Sure. So when we talked about the fund last segment, we didn't get a chance to kind of get into the nature and nuances of investing in it. So a couple things. First of all, we do have a minimum investment requirement, and it's $50,000. We also have investment qualification because we're not allowed to make we're not allowed to take investors who are not what is considered an accredited investor. So there's a net worth qualification of $1 million or more, not including the equity in your primary residence. And then third, the investment timing is 2-year minimum. So we ask that our investors expect to keep their money in there for at least 2 years. Now you can get your money out sooner, but we do charge an early withdrawal premium. Now, our fund is targeted to pay 8 to 9% on an annualized basis, and the premium for early withdrawal starts at 5%, and then over a 24-month period ratchets down to about 2%. So even if you had to take your money out, let's say,
After 13 months.
Yeah, after 13 months, and you ended up paying a 3% premium, you're still money ahead. So
So a lot better than the bank, that's for sure.
The early redemption premium is meant to keep people from treating it like a money market account, because this is a real business. We're making short-term loans to real estate investors. We need to be able to rely on the capital, and we don't want people going in and out. So we do have that 2-year redemption request. Now, after 2 years, we redeem monthly on the first of every month. The reason for that is we price our shares on the first of every month as opposed to daily, which I think a mutual fund would do. And again, why don't we do it daily? Well, we're trying to keep the expenses of the fund at a minimum. And so having a monthly redemption and a monthly share price calculation just keeps our administrative fees down. Again, we pay a third-party fund administrator.
And the less fees, the more fees that go down, it means more interest for the fund.
Right, and exactly. And for us to be able to pay out, a target rate of 8.5%, we're trying to be competitive in the marketplace in the San Francisco Bay Area, where private money loans can be as low as 8%. And I say as low as, if you're thinking, well, bank loans are only 4.5%, 5%. Well, again, in the private money realm, private money used to be, on average, 12%, and it's actually come down a few ticks in the last couple of years. So anyway, liquidity is fairly straightforward. We redeem share redemption requests on the first of every month, and because we do mostly short-term loans, we have a fairly constant supply of new capital.
And how do people get a hold of you one more time?
So again, call us at Pacific Private Money, 415-883-2150, or visit our website at pacificprivatemoney.com.
I've got my IRA with Mark, and it's true, earning over 8.5%. Tell you, we don't have enough time to cover this whole thing, so just with the Postal Service, they're going into Staples, and the union workers don't like it, and I'm going to get into this a little bit more next week, so stay tuned for the Best of Investing. Next week, we'll talk a little bit more about this article about how the Postal Union does not like the fact that Staples has non-union workers in there.
Oops.
All right, now, we're going to go to our thoughts for the day. I saw a sign that said, "Save the whales, collect the whole set." It must not have been from Greenpeace.
Must be a
that's for sure.
Japanese joke.
Yeah, really. And interesting, the latest survey shows that 3 out of 4 people make up 75% of the world's population.
I think that's true.
That is true. Okay, tune in next week to the Best of Investing. We're going to be giving away 9 more free vacations for answering trivia questions. Thanks for listening. On behalf of our team, I'm Edward Brown. We're wishing you the best of investing. So long.
And you came at the